Salute, folks. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, and I've returned today to whap and tap on your head with another ADH wealth solution. Today, your boy, the annuity anarchist, is returning, as today I'm going to be talking about 12 life and annuity changes in the $1.7 trillion spending bill, a December 22nd, 2022 article. Life insurance and annuity provisions in the Consolidated Appropriations Act of 2023, the 4,155-page $1.7 trillion spending bill, now flying through Congress, shapes clients' savings and investment decisions for decades to come. Groups like the American Council of Life Insurance, the National Association of Insurance and Financial Advisors, and FinSECA are going through the text carefully to see what's in there, how the current version of the language compares with earlier drafts, and which bits are the result of their work. The core of the bill consists of provisions needed to fund the operations of the federal government, but Division T is the text for the Setting Every Community Up for Retirement Enhancement Act, or the Secure 2.0 Act, a 358-page package of retirement and general financial security provisions. Some could improve the ability of annuities to provide a guaranteed source of income for retirees' entire lives. Division AA, another part of the bill, would affect the fate of a hot, relatively new type of annuity. What it means: if CAA 2023 makes it through the Senate and the House, and the President Joe Biden signs it into law, the package could have a big effect on your client's life insurance and annuity options. Spending bill status. Congressional leaders are packaging the CAA 2023 text as a Senate Amendment 6552 to H.R. 2617. Members of the Senate voted 70 to 25 Tuesday to proceed with consideration of the package. On Thursday morning, Senate leaders had announced that they had a deal for getting the bill through the Senate, but prospects for final bill passage were not certain. President Joe Biden, House Democratic leaders, Senate Minority Leader Mitch McConnell, and many states' Republicans support passage of the package. Some Republicans in the Senate, House Minority Leader Kevin McCarthy, and a group of Republican House members led by Republican Chip Roy, opposed the bill. The Roy Group wrote a public letter arguing that the spending package is an indefensible assault on the American people, and asking allies in the Senate to block it. The CAA 2023 Life and Annuity Provisions. Some sections of the CAA 2023 package that make no direct mention of life insurance, annuities, or related topics could turn out to have significant, possibly unexpected effects on life insurance and annuities. Here's a look at 12 sections that mention life insurance, annuities, or both, and look as if they could have an especially powerful effect on the products, the issuers, or the users of both. Note that although all parts of Division T are now part of CAA 2023 Secure 2.0 Act section, many of the provisions moved into the Secure 2.0 Act from other House and Senate bills, such as the Retirement Security and Savings Act of 2021 bill and the Enhancing American Retirement Now Act bill. So 1. Registration for index-linked annuities, Division AA, Title 1. The key annuity provision came from the Registration for Index-Linked Annuities Act bill, or H.R. 4865, rather than from the Secure 2.0 bill. Again, the stuff that I'm talking right now, hopefully your financial advisor or insurance agent is familiar, but just like a doctor who specializes, there's a doctor who kind of knows general biology, right? And then there's that specialist. The specialist is the guy who gets the specific money because he does the specific test on your neck that nobody else can do. That's what I am. It would be direct to the Securities and Exchange Commission to develop a relatively simple registration for RILA contracts rather than requiring RILA issuers to put a product through the same kind of registration process used when a company wants to go public. The Insured Retirement Institute of other life and annuity groups have argued that the change could make the popular products even more popular by cutting down on the time needed to launch a RILA product. Section 2. QLACs. Repeal of the percent premium limit. Division TT, Section 202. A qualified longevity annuity contract is a single premium annuity designed to pay income starting at a date in the future for the remaining life of a retiree. The QLAC program is designed to help reduce a retiree's required minimum distributions and federal income tax bills, while ensuring that at least part of the retiree's retirement savings will last until the retiree dies. One obstacle to QLAC adoption has been strict premium contribution rules, which hold down the amount of income a QLAC can generate. Current law limits the premium contribution to 25% of the account balance. The QLAC section in CAA 2023 will eliminate the cap on the percentage of the account balance that can be fed into a QLAC. This QLAC provision also appeared in a standalone Secure 2.0 bill, H.R. 2954, and in the Retirement Security and Savings Act of 2021, S. 1770. Issue 3. QLAC's premium amount limit increase. A second obstacle to widespread use of QLACs is the fact that the current federal rules limit the amount of premiums a taxpayer can contribute to a QLAC without running into RMD conflicts to $125,000 before adjustment for inflation, meaning that a QLAC can generate only a modest amount of annual income. One section of the CAA 2023 Secure 2.0 section would increase the maximum contribution to $200,000. This QLAC provision also appeared in the Secure 2.0 bill, H.R. 2954, and in the Retirement Security and Savings Act of 2021. 4. QLACs, dollar limit inflation adjustments. Another section of the Secure 2.0 Act would adjust the new $200,000 premium contribution limit for inflation starting 1 year after the enactment of the QLAC provisions. This QLAC inflation adjustment provision also appeared in the Secure 2.0 bill, H.R. 2954, and in the Retirement Security and Savings Act of 2021. We'll pause at issue 5, which ironically enough affects I have a lot of clients in New York City who are in the healthcare, and this always affects them. Qualified long-term care contributions, or the certified long-term care insurance. A lot of my medical professionals are always concerned of critical illness and long-term care insurance because they provide this type of care. And if you receive it, it's really expensive, right? To get a private room and a private nurse and all that, it's a minimum of $104,000 a year. And that's on the low end. So to get, your hood nurse CNA who drives a Nissan Altima and makes $40,000 a year, you're going to get somebody who's not happily wiping your butt. But that's why you get qualified long-term care distributions or certified long-term care insurance. So this provision is a part of a section that would let a 401k plan participant use up to $2,500 in plan assets per year to pay long-term care insurance premiums without a 10% early withdrawal penalty. A participant would have to pay income taxes on the distributions. Section 334 makes it clear that a participant can use the distributions to pay for annuities that provide long-term care benefits and life insurance policies that provide long-term care benefits, not just standalone long-term care insurance policies. The LTCI payment provision also appeared in the Enhancing American Retirement, now known as the EARN Act Bill, S4808. Actually, we'll do one more, which is issue 6. Insurance dedicated ETFs. So this provision would clear up a legal conflict that now makes it difficult for insurers to use ETFs, or exchange traded funds, in the funds menus inside variable life insurance policies and variable annuity contracts. The insurance ETF provision also appeared in the Secure 2.0 bill, H.R. 2954, and in the Retirement Security and Savings Act of 2021. Well, you know what, ladies and gentlemen, there's only a few more issues to go. I might as well continue. But before I continue, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule a one-on-one appointment with a licensed financial professional, the links are in the description of this video. So, issue 7, charitable gift annuity changes. So a client can use a charitable gift annuity to give a large sum of money to a nonprofit organization like their church, and then get a small amount of cash back every year. When the client dies, the nonprofit organization managing the charitable gift annuity keeps the remaining assets. So for example, instead of Miss Jones tithing 10% of her income every week to the church, she can actually tithe 5% to a life insurance policy that will massively multiply her single dollars. So when Miss Jones dies, instead of giving $10,000 a year for the last 50 years to the church, for a total of, $500,000, she can give $5 million to the church by giving $10,000 in 1 year to an insurance company and multiplying her money. Section 307 in CAA's 2023 Secure 2.0 section would let a client move up to $50,000 from an individual retirement account into split interest charitable giving arrangements, such as a charitable gift annuity, charitable remainder annuity trust, or a charitable remainder unit trust. Current law caps the amount of cash a client can pull from a charitable annuity at $100,000 per year. One part of Section 307 would index that cap for inflation, starting with distributions made in taxable years beginning after the date of the enactment of Section 307. The kinds of charitable gift annuities described in the provisions are transactions between the givers and the nonprofit organizations, not commercial annuity contracts. But the nonprofit organizations might use life insurers to manage their charitable gift annuity programs, and donors might use charitable gift annuities alongside commercial life and annuity products. The charitable giving provision also appeared in the Secure 2.0 bill, H.R. 2954, and the Legacy IRA Act Bill S243. Issue 8, elimination of the 401k plan partial annuitization penalty. This provision could ease the effects on the RMD rules on a client who holds both an annuity and other types of assets in a 401k plan. Today, clients with annuity assets may end up having to take bigger RMDs and pay higher federal income taxes than if they held no annuity assets in their retirement plans, according to an analysis by Groom Law Group. The partial annuitization provision also appeared in the EARN Act Bill S4808 and in the Retirement Security and Savings Act of 2021. 9. Pension annuitized benefit buyout value notice requirement. This provision could reduce the number of clients who trade defined benefit pension payment streams for lump sum payouts. That's actually good. I don't even think they have defined benefit plans now. Most of the time you're getting defined contribution, but companies are taking too much loss, so that's why they created the 401k and got rid of things like the pension, because pension literally means payment till death, just like mortgage means payment till death, just like 401k means period certain, just like an annuity is a payment till death. It will require pension plan sponsors who offer buyouts to show the participants what an equivalent commercial annuity might cost and report on the buyout offer results to the Pension Benefit Guaranty Corporation. Because this provision would compare the value of pension plan benefits with the value of individual annuities, it might increase plan participants' awareness of individual annuities. Good for you, the client, not good for us, the salesman. The value notice provision also appeared in the Retirement Improvement and Savings Enhancement to supplement healthy investments for Nest Egg, Rise and Shine Act Bill. 10. Auto enrollment in 403Bs. This provision could increase the number of clients enrolled automatically in employer-sponsored retirement plans by making it clear that the Secure 2.0 retirement plan automatic enrollment provisions apply to the teachers, government workers, and other participants in nonprofit employers' annuity-based 403B retirement plans, not just to participants in 401k plans. The automatic plan enrollment provision also appeared in the Secure 2.0 bill. Issue 11. Substantially equal periodic payments and plan rollovers. This provision could help clients who are tapping retirement plan assets early use annuities in SETP arrangements. The rollover provision for retirees using the substantially equal periodic payment rule also appeared in the EARN Act Bill, S-4808, and in the Retirement Security and Savings Act of 2021 Bill, S-1770. And the final issue is 12, the review of the DOL Pension Risk Transfer Guidelines, Division T, Section 321. This provision could affect the security of clients' pension benefits. It would require the U.S. Labor Secretary to look into the possibility of updating the standards for the group annuity providers that can assume pension risk from pension plan sponsors through pension risk transfers. The Pension Risk Transfer Study provision also appeared in the Pension Risk Transfer Accountability Act of 2021, Bill S-3746. That's going to be it for today, ladies and gentlemen. Make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule a one-on-one appointment with a licensed financial professional, the links are in the description of this video. With that being said, ladies and gentlemen, wipe ass. Work in progress every day and see success. And remember, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.